Hello and welcome to Now Educated. We are on our fifth episode, people. We are on number 5 and we're still counting them. And I'm sure in a couple of months, in a couple of years, we won't be keeping count of the numbers. And most of us will be in such a better place with our money and really getting to that point where we are moving towards financial freedom, peace of mind, and all that good stuff. How do we get there? You listen to the Now Educated podcast. Pleasure to be of service. And in this episode, I want to start off with questions as usual. And the first question I want to ask you is, have you ever been sick before? Needed to see a doctor? Been hospitalized? Maybe even been in an ambulance? If you've got kids, have your kids been sick? If you've got a spouse, has your spouse been sick and a financial commitment was required of you in order to get them whole again? Have you ever had to then invest in something permanent like a set of crutches, wheelchair, or like me, a set of glasses? And each time we do this, the money usually probably comes out of our pocket. Or if you're fortunate, you've got a company that's got you on medical aid, or you invest in medical aid, but either way, it's money coming out of your pocket in anticipation of a potentially negative health event or just preparing for the future. So like we were talking about the emergency fund the last time, sometimes you can protect yourself or protect your health by taking out things like medical aid, seeing a doctor. But the one thing about all these things is they take money out of your pocket. And today we're going to find out how we can get some of that money back into our pockets. So the thing we were talking about was, if you want to build wealth, one of the things we must start doing is saving our money, paying yourself first. When you get that paycheck, when you get a bit of income, the first person you should think about is you, specifically your future self, and how you can begin to build resources now and begin to invest your money now so that your lifestyle is protected in the future from emergencies. Your lifestyle is moving towards financial freedom. And you only do that by putting away some of your money today so that it can grow for you tomorrow and over the years, and to a point where that discipline becomes something that creates tremendous financial wealth for you, and hopefully in the process peace of mind and a lot more family time, or time for you to pursue the things that you call the desires of your heart. Now, very often we ask ourselves, man, Terry, where am I going to save this? Well, you should see the job I have, man. I don't earn that much. This is stuff that we tell ourselves. Oh man, I've got so many expenses. I've got so many bills. And I often find that by the end of the month, I don't have any more money to spare. It's a great idea. Yeah, in theory, saving is dope, but I don't have that money to save. There is no capacity. I often find myself having more month than money. So today, that's what I want to talk about. Where we can find savings or money to save. And I'm going to try and help you find it in the most unlikeliest of places, a place that many of us probably don't think about. And there's this authority, and try and see if you can pick up who this is before I tell you the name. There's an authority in our country, in Zimbabwe, and I suspect in many other countries as well, this authority commands the same sort of reputation. Now, this authority is by most disliked because it seems to take out money from people's pockets more often than it gives them back. This authority is respected almost to the point of fear. When these guys drop you an email, visit you at your office, or get in touch with you, it's almost the equivalent of being called to the headmaster's office back in the corporal punishment days. That's the feeling you get. Even if you're doing the right thing, just a call from these guys, just a visit from these guys is enough to make the average Zimbabwean, the average person shiver. And they're disliked, like I said, because very often they're taking money out of your pocket. And I'm not talking about your cousin Taffy. Who I'm talking about is the Revenue Authority, or in Zimbabwe, we call them Zimra, the tax man. The man who shows up every time you get paid. their handout, and they probably want to take anything between 20, 30 to 40% of that income, apparently for a very good reason. What if I told you that the taxman actually wants you at certain times to make more money? They want you to make more money, and not just make more money so that they take it, but they actually want to help you increase the net income that stays with you. Would you believe me? And if you don't, or if you're wondering what the heck is this guy talking about, this is what today is about. I want to show you in the few minutes we have together how Zimra. So this one, I'm gonna narrow it down to Zimbabwe, and I hope in our conversation, whichever country you're listening to this from, you take some time to understand how your taxman works and what's out there that your taxman has for you that could put money into your pocket as opposed to taking it out. And that money is the money that you can begin to use to build up your savings plan. You ready? Let's go. Now, there's this thing that our tax authority, or Zimra, has, and if you go to their website, if you're in Zimbabwe, it's Zimra, Zimra.co.zw. You want to go to their website and you want to go on the search string. So usually where they allow you to search, I think enter search term, and I want you to type. I want you to be able to do this for yourself as well, and just trust my word. And I want you to type in that search box, tax credits, right? Tax credits for individuals. And when you do that, it takes you to information around the tax credits applicable to individuals. You're wondering, what's a tax credit? Okay, so a tax credit is when Zimra creates a scenario where they give you an incentive or a tax credit, which is a way to reduce the amount of tax you pay as an individual, right? The amount of money you pay in taxes out of your earned income from employment, trade, and investment. And the aim of it is to reduce the tax that you have to pay to the tax authority. So according to them, the purpose behind the tax credit is to increase your disposable income. If you don't know what disposable income means, it's the income after they take out their tax. So hypothetically, if you were being taxed, if you earned $200, and hypothetically on a normal month you're being taxed $30, which means your disposable income would be the $200 minus the 30, which means the 170 is disposable, which is money available to you to spend, invest, and do all the things that you can do with $170. Now, when they introduce a tax credit, what they're saying is we want to find a way to reduce the $30 you're paying in taxes, maybe even slash it in half, which means if you get a tax credit for $15, that means that the actual tax you pay is now $15, and your disposable income jumps from 170 to 185, which means you have more money available to you. And they're very specific with these tax credits that they're meant to cater for things, so you just don't get it just for being Zimbabwe, right? We're not like that way. Remember, this is Zimra. It's to help you with certain special social welfare needs, and specifically things to go towards the improvement or maintenance of your health, or towards the control of a permanent physical, mental, or visual disability. So I get into the visual department because I wear glasses. So it's really to help you reduce the amount of money that those special social welfare needs take away from you, right? So how does that look? So what are some of those categories? So I'm not going to spend too much time on mentally or physically disabled, but if your doctor diagnoses you with some sort of disability, right, or either physical or mental, what you just need to do is have either the letter from the doctor as proof, or something that maybe you're using a particular device, but all you need is just that verification that you've got a condition that falls into falls into the mental or physical disability. And if you're a taxpayer, remember these tax credits only apply to people who pay their taxes. So if you evade taxes, you can't get a tax credit for something you're already not paying, right? So if you're employed or you run a company and you happen to pay payee, so pay as you earn, that's what we call payee, or your company pays taxes each time. The moment you become a taxpayer, and maybe you've got some sort of mental disability or physical disability, what they do is they give you a credit of the equivalent of $900 per year. So that means that translates to $75 per month that comes to you as a tax credit for just having that disability. So let's go back to our example. So let's maybe look at, let's do 500. Let's say you earn 500 a month, and purely hypothetical, your tax bill is $100, right? So if you have a physical disability and then you notify your employer and say, look, I've got this physical disability, here's the doctor's letter to prove it, or here are the association that actually verifies that I'm part of this particular community. That means your employer is obligated to, instead of remitting the $100 that they were, probably before they knew that you fell in this category, they need to reduce $75 every single month from your taxes, which means instead of paying $100, you're now only paying $25, and that $75 goes, and now your take-home salary or your take-home income is actually $475, right? And this is every single year. You're allowed to do this up until you can claim up to $900 as your benefit for this. All right. And if you happen to be married, that means, and your spouse goes to this, or your child has a mental or physical disability, you can claim that as well, right? Because if you are a family person, if your family has illness, chances are high it's coming out of your income. So you can also claim that benefit and get your employer to deduct that for you. Remember, it's per taxpayer, so that means $75 a month is the cap, and you've got up to $900 a year. So that's the limit, right? The second thing is, if some of us are getting older, and really happy to say I've got some of my friends who are pushing on to 55, and you know that when you hit 55, you also get what they call an elderly person's credit. So which means the moment you hit 55, the year you turn 55, you become eligible to start receiving a tax credit, monthly reduction in the amount of income tax you pay to Zimra every single month. You can start reducing that by $75, which translates to a total of $900 every single year. And the only thing you need to show proof of that is your birth certificate that clearly shows that you're 55. So if you are 55, but you went and took your birth certificate at age 15 or 20, and it's showing 45 or 40, you're 40 according to the nation, right? So if your birth certificate proves it, then you can submit that to your employer or the person who does your payroll or who pays your salary. If you do it yourself, you can just attach a copy of that, and when you do your tax returns to Zimra on staff salaries or payee, you just show that this dude's hit 55, so they're on this gravy train to the elderly person's tax credit. Sweet. The same thing applies for a blind person's credit. You get similar $75 a month, $900 a year as a tax credit. All right. Now, let's get into the next credit. So there's these things that I don't know why they call them invalid appliances, and it's quite offending. And I hope Zimra takes some time to really, come up with nicer ways to talk about people like me who wear glasses. But there's this thing that they call invalid appliances, and examples of invalid appliances are a wheelchair, if you need to get an artificial limb, leg calipers, crutches, any special fittings for the modification or adapting of a vehicle, bed, bathroom, toilets to enable use by someone suffering with some sort of physical ailment, or I hate the word defect, but that's what they put on their website. Or if you're like me and you have to wear spectacles or contact lenses to sort of aid your sight, and some, I suspect even those who just want to look good in contact lenses. Those are what they consider invalid examples of what they consider invalid appliances. Now, if you purchase any of these, like me, when I go and get my glasses, I can get to the optometrist and they can tell me, hey, Terry, your glasses are going to be $200, right? And let's assume that I don't have medical aid for now, and I pay that $200 for my glasses. As a tax-paying citizen, the receipt I get from my optometrist for that $200, I can take that to my employer and submit that as proof of payment for my spectacles. And that means the employer will need to give me back 50% or reduce my tax, the amount of tax I paid to Zimra, by $100, 50% of that. And that will be for, and the reason for doing that, it will be a credit for the cost of purchasing invalid appliances. That's a credit due to me for the cost of purchasing invalid appliances. So that means for every dollar I spent, I get 50 cents dollar I spent towards the purchase of these appliances that aid my health, physical, visual, or mental well-being. I am entitled to getting 50 cents back. So if you want to look at it differently, it's almost like Zimra saying, we will pay half of your bill on some of these medical health related issues. So Zimra is going halvesies with us. Would you have ever thought about this? And what I like about this credit for the purchase of invalid appliances, and the one we're going to talk about in a second, is that you can apply this to your spouse, you can apply this to your children, and this includes both stepchildren and legally adopted children. Okay, so I'll repeat that, right? You can apply this credit to your spouse, your children, and those are including stepchildren and legally adopted children. So when I get my spectacles, I always know that whatever I pay out of my pocket, Zimra's got half. They got half there for me, right? Let's go to the last one before we bring the conversation back to how we use this to boost our savings. Now, the last credit I want to show you and hopefully get you to understand is what they call the medical expense credit. Applies the same sort of fundamental principle of a total of 50% of medical savings. It gives you a credit for 50% of whatever you spend to cover medical expenses, all right? And these are expenses that we incur that are medical related and that you as the taxpayer pay for yourself, you pay for your spouse, you pay for your minor children, remember, including your stepchildren, legally adopted children, and it cannot be extended to anyone else. All right, so not your grandma, your grandpa, and I know for a lot of us, not even our parents qualify for this tax credit. So don't get carried away. If you do that and claim it from your employer and get caught, you will remember why Zimra is Zimra, because those guys will shut you down, right? And it won't be allowed. So this credit, you have to be very careful with this credit. You don't want to claim it if, for example, what the medical expense you are incurring is fully covered, for example, by your medical aid, and there are no shortfalls. You are not allowed to do that. So if you've got medical aid and your medical aid fully covers this expense and there are no shortfalls due to you cannot claim the medical expense credit. If you do, you will be lying to the government and liable to get in trouble. All right? Okay. So what is included in the medical expense credit? Or what kind of medical expenses are we talking about? This means each time you go and see your medical or your dental practitioner, so each time you go and see a doctor and you're paying out of pocket or your medical aid doesn't fully cover the cost of consultation, 50% of that shortfall is what you can claim as a credit. If you're buying drugs or medicines as part of a prescription from either a doctor, medical doctor or a dentist, you can claim your medical expense credit. If you happen to be admitted into a hospital, if you have required the nursing services or treatments, those home-based care, if you need blood transfusion, x-rays, laboratory tests and examinations, medical tests in a hospital, being admitted in a hospital, being in a maternity home, nursing home, sanatorium, surgery, clinic. I think you kind of get the drift, right? Each time you get into any of these facilities that provide medical services, you can claim this medical credit. If you happen to be transported by an ambulance, and this even includes an air ambulance, and apparently those things are not cheap, right? You can claim 50% of whatever you put out financially. And if you happen to be fortunate to have a medical aid, or you're contributing towards a medical aid, 50% of your contributions, if they are being done by you as an individual, and your company doesn't do this. If your company doesn't do it, stay clear. If you're paying these out of your own pocket, so if you've got medical aid contributions that you pay to a medical aid society, and you covering yourself, your spouse, your kids, the works, you can claim this credit. And the evidence you should produce in order for your employer to reduce the amount of tax they pay to Zimra is just evidence that of the expense. So it could be receipts that you got, it could be letters from your doctors, letters from them that just show that you were admitted and this was the bill. And clearly these places in Zim, you don't just get medical treatment for free. That proof is all you need to supply to your employer, and 50% comes back to you. Now, remember, a couple of things to think about these credits is, I keep talking about your employer or your companies, because in this country, in Zimbabwe, the employer or the company works as an agent of Zimra. So that's why to get your credit, you don't have to wait months or submit it like an application. The moment you present this evidence, the moment you turn 55, the moment you are verified to have a special ability, right, or a disability, depending on how you want to look at it, you can get that money back into your bank account, into your hands, the moment you run the next payroll. You with me? So your employer, if you show this to the employer, remember, if they don't know it, I've just given you the website that you can go to and get this working for you. Let's bring it home. Now, with all these credits, with all these things, you're probably thinking, wow, I should pray for Zimra a little bit more, shouldn't I? Why would they do that? This sounds too good to be true. And really, yeah, it does. We don't expect our tax authority to be wanting to give us money or wanting us to have more disposable income and in a way paying less taxes. But look at it this way. The healthier you are, the healthier your family are, the healthier your kids are, the more peace of mind you have, the more likelihood of you being productive in whatever you're doing. And which means your performance is better, your company does better. And if you're healthy as well, God willing, you live longer. When you live longer, guess who's making more money in taxes? So you are Zimra's investment. You are their product. You are their cash cow. And this is their way of saying, we want to take care of you because we know you're going to take care of us. At least they even think about their asset, right? Making sure their asset is as productive as possible. So now that you know that you've got a 50% of your medical aid contribution, if you do it yourself, can come back to you on your paycheck. If you incur any medical expense in any given month, that's going to come back to you on your paycheck. If you purchase any what they call invalid appliances, glasses, contact lenses, wheelchairs, crutches, the works, there's a credit due to you. If you've hit the age of 55, there's a credit due to you. If you have a visual impairment, there's a credit due to you. And that's all money coming back into your wallet. And that's money that I'm sure some of you have been leaving on the table. And that could be the money you could start using from today to start saving. Because before, it was going to Zimra, and now that's the money you can start putting away and start building your future and creating a livelihood that you can be proud of, that brings you more joy than distress, that moves you closer and closer to financial freedom and a healthy relationship with your money. So let's bring it home. go to your country, find out what the tax authority, some of the credits that are available to you as a tax-paying citizen. And when you come across these, that could be the money that you weren't spending before on yourself, and use that to start your journey towards saving. Use that to start building your Konapo fund, to start building your emergency fund, and move you closer and closer to your financial destination. My name is Terrence. I hope you are now educated, and at the end, when we know better, we do better, and everybody else gets better. And when that happens, everything gets better. Catch you on the next episode.